So I am doing the very basic explanation of depreciation. What is depreciation? Do you know what is depreciation?
Yeah, when the value of an asset decreases throughout its lifetime.
Which asset, the value of which asset decreases?
Non-current assets.
Okay. Say, for example, if you're a car manufacturing company and you have your non current assets, that is a machinery that you have. Okay.
Yeah.
You bought that machinery for 100,000. Can you say that after 5 years, the value of this machinery will remain 100,000?
No,
Hmm?
no, it
The
won't
value of this machinery will
decrease
decrease. Why will it decrease?
because it's been used for a period of time.
Okay. So when you are using your value assets continuously, what happens is the value decreases. And that decrease in the value of the asset is called depreciation. So can you tell me what is depreciation?
Depreciation is an estimate of the loss in value of a non-current asset over its expected working life.
Okay. So you estimate that you are going to have a loss. You are going to face a loss because the value of your non-current asset is decreasing. Are you with me?
Yes.
So do you think value of all the non-current assets decreases over a period of time?
No, not all non-current
Which
assets.
non-current asset does not decrease, the value does not decrease over a period of time?
Yeah, some assets increase over time.
Which is that asset?
Land, property.
Land and property. Okay. Now what is the reason why we do depreciation? Say for example, I bought my machinery for 100,000. The cost of my machinery is 100,000 and I am in year 1. Are you with me?
Yes,
When I go to year 2, will the machinery still be of 100,000 or the value will decrease?
the value will decrease.
Okay, the value will decrease by some amount, and that some amount is our estimation because we do not know exactly by what amount the value decreases. I am giving you a random example. Say, for example, the value of your non current asset is decreasing by 10,000. So, in year 2, is it good to show your asset at 100,000 or
No.
it is fair to show it at 100,000 minus 10,000 and 90,000?
Yeah, it's better to show at a realistic value.
So basically, the reason for accounting of depreciation is that if we show our assets at the cost price in our statement of financial information, if we record assets at cost price in our SOFP, we are giving misleading information. We are telling that our assets value never decreases. So the reason why we account for depreciation is that we say that the cost of our asset is this much. Over a period of time, there is a fall in the value of the asset. This is our estimated loss. What is this?
Estimated loss.
So this is our estimated loss in the value of the asset, and our asset will be recorded at the net book value. So the question that comes over here is, how is depreciation treated in your financial statements? Can you give me two financial statements that we have?
Income statement and statement of financial position.
So we have two financial statements. Our first financial statement is income statement, and our second financial statement is statement of financial position. So how do we treat depreciation in our financial statements?
In income statement, it's recorded in the other expenses. In SOFP, it's recorded in the non-current assets section.
Non-current assets section, which column? The first
Third,
column will have what?
first column is the cost. Second is the depreciation.
The second column will be for the depreciation, and the third column will be for the net book value. Okay, so how is
Yes.
depreciation treated in our financial statements? It is treated as other expenses, and we subtract the amount of depreciation from the non-current assets to arrive at the net book value. Are you with me?
Yes, miss.
Can you tell me reasons why you depreciate your non-current asset?
So that our assets can be recorded at a realistic value.
Okay, other reasons why you depreciate your non-current asset.
Physical deterioration,
What is
economic,
physical deterioration?
it worsens over time or something like that.
Physical deterioration is caused by the physical wear and tear use. So, see,
Oh,
if you have a
yes,
non-current asset and you're using your non-current asset, there will be some damage to your non-current asset.
yes,
There will be some damage to your non-current asset. This damage is called the physical wear and tear, or I would say it is called the physical deterioration that is caused due to use. This is our first reason to depreciate the non-current asset. Second reason would be depletion of your fixed assets. What do you mean by that?
an asset that depletes over time as resources are extracted from it. So it
Suppose
tries,
this is a gold mine.
yeah,
So when you extract the gold from it, the value of this asset will reduce. So depletion of the fixed assets. Third reason why your asset is depreciated. Can you give me first and second reasons? Reasons
uh,
for depreciation.
first is physical deterioration,
Hmm.
and second one is depletion of fixed assets.
First is physical deterioration. Second is what? Depletion of.
Fixed assets.
Third,
Economic reasons.
economic reasons could be. Economic reasons means there is some money part involved in it. Maybe your asset has become obsolete.
Okay.
What do you mean by obsolete?
Uh,
Outdated.
yeah, outdated.
Okay. When iPhone 14 when iPhone 14 has come in, iPhone 13 has become outdated. Yeah. So the
Yes,
value of iPhone 13 has gone down because a new version of the asset has come into the market. So the other
okay.
reason why you depreciate your non-current asset is because the non-current asset has become obsolete and new and efficient assets have come in place. Passage of time, because it has taken, we've been using it for a number of years. So the asset has depreciated and the value of your non-current asset has fallen. So can you give me reasons why you depreciate your non-current assets?
Yeah. Uh,
Solines, when the
for
new
physical,
model comes, old models expire.
yeah,
Yeah, so can you give me reasons for depreciation, or I could say causes for depreciation?
yeah. Physical wear and tear.
Hmm.
First reason. Second could be depletion of fixed assets.
Hmm.
Third is economic reasons.
Hmm.
Uh, fourth is passage of time.
Yeah, so they will ask you only two. Now, when I talk about methods of depreciating a non-current asset, when I talk about methods of depreciating a non-current asset, so I would say there are three methods to depreciate a non-current asset. First method is the straight line method, which is also called the fixed installment method, or it is called the cost value method. Okay? Straight
Okay.
line method, fixed installment method, or cost volume method. You are depreciating your asset on cost. Second method for depreciation. Second method for depreciation is what?
Reducing balance.
Reducing balance method or diminishing balance method or written down value method. Okay. Here the asset is depreciated on the reduced value. And third is the revaluation method. When they give you the value of your non-current asset at start, value at the end. So the value has changed. So this becomes the revaluation method. I just want you to go through this. I will pause the recording. Go through it and try to figure out the three methods. So let's talk about the straight line method. When I talk about the straight line method or the fixed installment method, there is a formula to calculate depreciation when the rate is not given to us. Okay. Straight line method, what happens is that you are charging depreciation on costs. When I say depreciation is charged on costs, that means every year same amount of depreciation will be charged on the cost. Same amount of depreciation is charged every year. They would either give you the cost and they will give you percentage. Say 100,000 is the cost of the asset, and they would say you depreciation is 10% per annum. Are you with me?
Yeah,
So the depreciation will become how much? 10% on cost.
yeah, okay.
So 10,000. So every year you are going to charge the same amount of depreciation. Are you with me?
Yes, miss.
Suppose they don't give you the rate of depreciation. So in that case, what will you do? Your depreciation will be costs value minus scrap. Scrap is the money that you will get when you sell the asset divided by estimated useful life, or you could say number of expected years of use. So
Okay.
costs minus scrap divided by estimated useful life is going to give you the depreciation that you are going to charge per year. Let's take it with an example. I'm talking about Kavita. Can you read this question?
Yeah, miss. Kavita's financial year ends on 30th June. On 1st June, on 1st July 2023, she purchased fixtures costing $25,000 and paid by check. She estimated that she would be able to use the fixtures for 4 years and then be able to sell them for $3,000. Calculate the annual depreciation charge as an amount of money and as a percentage.
So when I talk about amount of money, so depreciation would be costs minus scrap upon estimated useful life.
Yeah,
Cost is 25,
yeah,
scrap is 3, estimated
yes,
useful life is 4 years.